I'm Taylor Ricks in San Francisco. This is Bloomberg Technology. Coming up in the next hour, embarrassing yourself. Softbank's Masayoshi Son said he's embarrassed by his record. We discuss Softbank's portfolio, including WeWork and Uber. Plus, competition heats up in online food ordering. I get the scoop with leading digital food ordering platform for the restaurant industry. That's Olo. And no longer PayPal's. PayPal confirms that it is bailing on its commitment to Facebook's cryptocurrency project. Why analysts think that's a wise move. But first, to our top story. Softbank set some lofty investment goals thanks to CEO Masayoshi Son. But so far, returns haven't lived up to expectations. Son tells Nikkei Business that, quote, "The results still have a long way to go, and that makes me embarrassed and impatient. I used to envy the scale of the markets in the U.S. and China." He then goes on to continue, "There is just no excuse for entrepreneurs in Japan, myself included." Joining me to discuss is Bloomberg Technology's Sarah McBride. Sarah, what was your key takeaway from this interview?
Well, it turns out that Masayoshi Son was being asked kind of more broadly about the Japanese environment, and so you can interpret his result to be more broadly, why aren't there more entrepreneurs in Japan? Why isn't the startup scene in Japan as vibrant as in some other places? He specifically mentioned Southeast Asia. There are a number of unicorns out of places like Singapore, and it's just hard to see anything similar in Japan. So in that context, I think you can't say, oh, he was just upset at himself over the Vision Fund or something narrow like that.
Well, and remind us again about some of the big successes you think in Alibaba, and then some of the more recent flops that we've been talking about,
Right.
like in Uber or WeWork.
Right. So if you look over his whole career, he was almost broke at the time of the first .com bubble, but he had one good investment that saved him, and it was in Alibaba. So he made many, many other investments that just flopped, and one that pulled him through and gave him the foundation to do everything he's done since. So he likes big bets. And then since then, he's had some other good investments, even at the Vision Fund, which is easy to forget when you just think about WeWork, but they had a very good exit, for example, in Garden Health, which IPO'd and gave a nice return to the Vision Fund. They sold Flipkart to Walmart, which again gave them a very good return. The problem is, since then, there's been a lot of bad news.
In that article, did we learn anything new about Uber and WeWork and his thoughts on the two?
Yeah, I mean, he is consistently a long-term thinker. So he said in 10 years, Uber and WeWork will be very profitable. They're great companies. So he's just continuing to think on a very long-term basis. He's famous for giving a presentation that was titled The 30-Year Plan. This was back in 2010, and he actually ended up talking about a 300-year plan. So he has a longer threshold than the rest of us.
And part of that longer threshold, I wonder if the market's sort of misinterpreting him at this moment, because he talks about a 30-year plan, a 300-year plan, and yet you and I, for example, look at Uber and WeWork and just analyze it in the last 6 months. Are we sort of missing his broader vision that is a 30-year plan?
Yeah, maybe we are, but say you're retiring right now. You don't have the 10 years or the 30 years to wait for the company to turn a profit. You might need to cash out some of your retirement savings. So it would be great if everybody were aligned in terms of investment threshold, but for a lot of people, that's just not possible to think that far out.
We've talked a lot about Uber with Masayoshi Son, the Vision Fund, and I wonder as we think about the rest of that portfolio, sometimes it seems relatively concentrated. I was looking, they have Didi in China, India's Ola, Singapore's Grab. Are there concerns that it might be too concentrated perhaps in that ride-sharing space? So when there's concerns about Uber, it trickles into concerns about a lot of the other ride-sharing companies.
Yeah, I think that's a valid concern, but that's their whole strategy. They like to make big bets on certain sectors. So if they invest, say, in one ride-sharing company or one real estate company, they like to build a little constellation around that and try to achieve synergies among those companies, which is great when it works, and then if it doesn't, we see what we're seeing right now. I should add that for the Vision Fund in particular, it was last valued by Softbank at June 30th at $82 billion. So it'll be really interesting to see where it's valued for September 30th. And it only includes investments that it currently has, not its exited investments there.
I want to finish on another quote that I got from that article, which Masayoshi Son says his goal is to invest in companies that share his vision of the world that's being changed by AI. Do we expect more and more of those portfolios to be of companies that are driven by AI?
Yes, but also almost every company is more driven by AI now. So no matter what you invest in, you can make an argument that it fits in that AI mandate. And he's done a lot of thinking about how AI can improve the human condition overall, not just technology, but how it has impact for human despair and sorrow and loneliness. So he has these high-minded goals.
And how has his stance changed? I wonder if they've learned anything from WeWork, their stance on both profitability and now corporate governance.
Well, I think there's more of an emphasis on corporate governance. And in that article, he did tell his portfolio entrepreneurs they have to know their own limits. So by that, you could interpret it to mean know your corporate governance, be aware of that.
Bloomberg Technologies, Sarah McBride, thank you. And in India, e-commerce is catching on in smaller towns. Amazon and Walmart reported record revenue for their 6-day Indian sales festivals. The American rivals have been dueling in India since Walmart paid $16 billion for control of local pioneer Flipkart last year. Their latest sales promotions ran on the same days and concluded over the weekend. And coming up, hacking an election. Microsoft calls out Iran for trying to hack a presidential campaign. We look at how safe 2020 candidates are in cyberspace. That's next. And if you like Bloomberg News, check us out on the radio. You can listen on Bloomberg app, Bloomberg.com, and in the U.S. on SiriusXM. This is Bloomberg. A group of hackers linked to the Iranian government are being accused of trying to hack a U.S. presidential campaign. Microsoft says the group, it's known as Phosphorus, tried to infiltrate email accounts of a campaign as well as those of former U.S. officials and journalists. Joining me to discuss in Washington, Bloomberg's Eliza Sebanius, who's been covering this story, and John Holtquist. He's the director of intelligence services for cybersecurity firm FireEye. Lisa, let me start with you. What are the specifics that we know about this case as it relates to Microsoft and Phosphorus?
Microsoft told us that in August and September, a group of Iranian government-backed hackers tried to infiltrate hundreds of accounts. Of those, 4 were successfully penetrated, but that did not include the one presidential campaign that they noted was targeted by the Iranian government-linked hackers.
And John, when you take a look at this specific hack, what does it tell you? That cybersecurity clearly is the next frontier as it comes to meddling in U.S. elections?
Well, campaigns are undoubtedly on the front lines of national security. There's a place where policy begins. The Iranians right now are trying to figure out what the future of American policy as it pertains to them is, and campaigns are a good place to look.
Eliza, talk to me about the specific tactics used in this case.
According to Microsoft, they used fairly rudimentary tactics. However, they were very much after personal information, which shows, according to Microsoft, a willingness to be very persistent and engage persistently as they seek to hack these kinds of accounts. This suggests that perhaps 2020 can look more like 2016, when Russia managed to do cyber operations against members in the U.S.
John, do you agree that these are rudimentary attacks, but it's the persistence that makes you so concerned that it could look similar to the way the 2016 meddling looked?
Well, campaigns have always been targets for cyber espionage. Not just the Iranians, the Russians, obviously, and the North Koreans have done this as well. The real question is whether or not they're going to carry out the hack and leak, the more aggressive operations that we saw in 2016, which are really the more disconcerting.
Well, and John, do you see that?
Well, we haven't really seen that yet. Like I said earlier, the Iranians are trying to answer serious questions about how the U.S. is posturing ourselves in the Gulf. They have a very uncertain future with regards to sanctions, with regards to the nuclear agreement. And their first use of this kind of capability is just going to be to answer questions. So it's very possible that they could target these people quietly just to gather information.
And John, are you able to say if you have been tracking phosphorus or if this is one group that you've been following that you've known could be a potential threat?
Oh, we've been tracking phosphorus, who we call APT-35, for about 5 years now. We first found them targeting defense industrial base in the United States, as well as Iran hawks, people who are in John Bolton's circle, for instance, pro-Israel lobby, and a few other targets, carrying out a really elaborate social engineering scheme through social media. They have a lot of different capabilities, and even though sometimes their attacks may seem rudimentary, they make up for it with a lot of gumption.
Lisa, what do your experts tell you? As you've been reporting on the story, it's been rudimentary skills, but it's been gumption. Do your experts all agree that this is sort of the next frontier as we approach 2020?
As we approach 2020, we've heard a variety of warnings from the government and the intelligence community saying that nation states ranging from Russia to China to Iran will return with new tactics. Some have said that Russia, China, and Iran are already trying to influence the information space, which is, of course, the other side of this equation. But all signs point to a major concern within the U.S. government and within the campaigns that cybersecurity is a clear issue and could be used to attack the 2020 election. So there's a lot of emphasis on preparing for this threat and trying to make sure that 2020 does not look like 2016 did.
John, as you sit back and take a whole look at the election cycle, do you see this criminal activity start to heat up in the summer? Does it start now and get hot until the election 2020? What does that cycle look like?
It can begin as early as now. I think these actors are probably already looking to gain access where possible, even if we don't necessarily know what campaigns will shake out in the end. As we get closer, though, we're likely to see, if we are going to see these more aggressive hack and leak operations, they're going to come much later in the game, where it'll be much harder for us to react to them.
And John, you've mentioned a few culprits: Iran, Russia, North Korea. Who are some of the big players that you have your eye on?
Well, Iran, North Korea, and Russia are definitely big players. In addition to sort of the hacking activity, we are watching the information operations space, the trolling on social networks. It's not just Russia anymore. Iran and China are also doing it as well. All four countries are very aggressive and familiar with this capability and could be players.
John, is there anything that consumers can do on our end, or someone who's in the presidential campaign to do? What are we supposed to do besides rely on cybersecurity software?
Well, there are some extra steps you can take. Probably the best one would be to use two-factor technology, not just relying on a single password. Passwords can be very difficult to memorize, and that leads to a lot of security failures. A password manager can help out. If you don't expect to have some sort of physical threat, writing your password down might actually be safer than trying to memorize or use the same password again and again. So there are some very clear steps that we could take.
I am the biggest culprit of that, John. That was Bloomberg's Eliza Sebanius and FireEye's John Holtquist. Thank you both for joining me. And meanwhile, the Trump administration continues to move against China, placing 8 of the country's tech companies on a U.S. blacklist on Monday. The companies, which include 2 surveillance units, are accused of being implicated in human rights violations against Muslim minorities in the far western province of Xinjiang. And coming up, cash for content. Apple's got a ton of it. Will it be enough to leave Netflix behind in the streaming wars? That's next. And Bloomberg Technology is live streaming on Twitter. Check us out at Technology. Be sure to follow our global breaking news network at TikTok on Twitter. This is Bloomberg. Chipmaker NVIDIA rallied on Monday after analysts raised price targets. RBC upped the price target to $217, while Evercore raised it to $225. Both analysts cited positive trends in gaming and data centers. Plus, Smile Direct Club is getting rosy reviews from analysts. Despite the worst mega IPO performance since 2007, Wall Street analysts are enthusiastic for the company. Smile Direct has so far received unanimous buy equivalent ratings. And Apple shares are trading up on Monday. This is after Nomura raised its price target on the iPhone maker. Nomura cited, quote, solid demand for the new iPhone as it upped that price target to $205 from $185. And speaking of Apple, what does a company with $200 billion in cash do? Well, maybe spend it on content for its upcoming streaming service. While the company has not disclosed how much it has spent on Apple TV+, it could be in a position that current streaming service, Netflix, might describe as enviable. Joining me to discuss from Stamford, Connecticut, senior research analyst of D.A. Davidson, Tom Forte. He currently has a buy rating on Apple. Tom, broadly here, as you analyze the streaming service, do you expect Apple to outspend its competitors?
So I definitely think Apple has the potential to outspend. As you pointed out, they have a massive treasure chest. But the way that we've been talking about it is the speculation is they're spending $6 billion, up from the original expectation of $1 billion. And for Apple, that kind of puts premium content spending as more of a serious hobby and not really a job yet for the company. So I do think they have the potential to spend a lot more, but so far they haven't really shown that.
And put that $6 billion into perspective. What are some of the other competitors that you follow spending if Apple really is spending $6 billion?
So by way of comparison, Netflix, the market leader today, is in the $10 billion plus range. So $6 billion versus $10 billion is certainly a significant figure, but it's still lower than what Netflix is spending. And again, they have the potential to spend a lot more, but so far they haven't shown the propensity to do so.
Tom, I want to show a chart to our Bloomberg audience, and it's in my terminal here at GTV Go. And basically, we're just looking at net cash, which is cash of $200 billion on the balance sheet, minus debt of $108 billion. So you're still looking at net cash of more than $100 billion. Would you argue that Apple's balance sheet is in the best shape to be spending this cash?
So the answer is absolutely. So not that long ago, we used to joke that it was a great time to be a B-list actor with all the streaming video services that were coming online. The difference with Apple involved is now it's good time to be an A-list actor. If you think of Jennifer Aniston, if you think of the other A-list talent they're employing, Oprah Winfrey, Steven Spielberg. So Apple certainly has the checkbook to write some massive checks if it wants to pursue that opportunity even more so.
And then, Tom, as we take a look at balance sheet dynamics, you look at $200 billion in cash, and then you have a $65 billion free cash flow. We've all heard the story from Netflix of negative free cash flow and burning the money. How does free cash flow factor into your analysis here?
Yeah, so basically the free cash flow that Apple generates, not that long ago when Netflix was a smaller market cap, in a good quarter, Apple could have bought Netflix. So the beauty of Apple's business model as primarily focusing on the high margin products within a category, you think of them selling the most profitable smartphones as an example, enables Apple to generate tremendous free cash flow. And that free cash flow coupled with their balance sheet gives Apple a lot of dry powder, which they could use to go after premium content even more significantly.
Well, and Tom, I remember Apple had gotten a little bit of pushback from investors, from people on the street who were saying you're hoarding your cash, spend it, do a buyback, do a dividend. And Apple sort of stood its ground and said, we're going to keep our cash. Are we sort of laughing now as Apple now has rightfully so sort of built up this cash hoard for this rainy day?
So the good news is that Apple does return a large amount of cash flow to shareholders via buybacks and dividends. But more importantly, if you step back for a minute, what's most important to Apple right now is diversifying away from its overdependence on one product, being the smartphone, which was north of 60% of their sales in the last fiscal year. And if you look at their efforts in not only proprietary content, but also financial services, including payments and healthcare, then that large cash balance certainly gives the company a lot of money to invest in things that aren't directly related to smartphones, which is really good news for Apple and for Apple shareholders right now.
Well, and Tom, we have another chart here that I'm showing of Apple's reliance on that iPhone. And of course, as they raise the prices on those iPhones, you've started to see it slip. But this fits into that broader narrative, as you've been talking about, that Apple is a services company. It's trying to transition away from that iPhone. How do you see Apple TV play into the broader narrative that is really the future of Apple? Where does it fit into their strategy?
So definitely when I think about their pre-announcement, which was a huge shock last year, on weaker than expected iPhone sales in the December quarter, I think what that did is reset the bar. And that to the company's credit, it's been able to change the narrative, and investors are soaking up this narrative and reacting to it favorably. And it's the company's efforts to diversify away from their overdependence on the smartphone. Proprietary content is definitely part of that, along with financial services. You think of not only Apple Payments, but the Apple credit card, and then all the things they're doing in healthcare. So I look at proprietary content as one leg of a multi-legged stool.
I have to leave it there, Tom. So sorry to cut you off. That's Tom Forte of D.A. Davidson. This is Bloomberg Technology. This is Bloomberg Technology. I'm Taylor Riggs in San Francisco. Google is ramping up its restaurant industry footprint. Just last week, the tech giant announced that it would be partnering with Olo. That's the leading digital food ordering platform for the restaurant industry. This will enable customers to order directly from over 300 restaurant brands across Google Search, Maps, and the Google Assistant. Joining me to discuss, it's Olo CEO Noah Glass. Noah, from a financial perspective, walk me through the partnership between Olo and Google.
Sure, Taylor, thank you so much for having me. So the relationship is really about enabling our restaurant brands to be found by consumers when they're searching for restaurants on Google. Consumers kind of naturally do that today. They're looking for their favorite restaurants. Now they'll be able to find those restaurants, order directly from the Google platform, whether that's Search or Maps or even the Google Assistant, and then send that order directly through our platform into the restaurant's point of sale. I can't speak to the way that Google's financial model works. Our financial model is to be a subscription platform with transaction fees on top of that platform for increased order volume.
And so do you share profits with Google per click, When I click on the ad, when I click on your site, or when the delivery is confirmed?
So it's really coming from the context of consumers today ordering through different platforms like third-party restaurant delivery marketplaces. When they order through those platforms, they pay something, the restaurants, pay something between a 20 and 30% commission to those third-party marketplaces. This gives restaurants the ability to take orders directly from Google. Then we're just charging the restaurant a flat fee per month and a fee per transaction that pales in comparison to the third-party restaurant delivery marketplaces.
So talk to me about the restaurant side. Why would they want to be on your site?
Yeah, so restaurants are using Olo as their digital ordering and delivery enablement platform. We work with over 300 brands, over 70,000 restaurants across the United States and in Canada. And restaurants are looking to Olo really as their partner to help drive direct traffic into their restaurants. This is around developing a direct digital relationship with those consumers, and then also listing their menus on popular third-party platforms in a way that keeps the restaurant in control and enables all the orders to originate from outside of the restaurant and come directly into the point-of-sale system at the restaurant.
And are restaurants and Olo playing the volume game here?
Yeah, I mean, this is an amazingly seismic shift that's happening in the restaurant industry. We're going to a place where over half of the overall sales in an $800 billion industry are taking place through consumers that are looking to get their food and consume it off premise. And we're moving towards over half of that coming through digital channels. So the restaurant industry has never seen a shift like that, and we're all about helping our restaurants to be the great beneficiaries of that shift and get their orders coming directly from their customers and building that direct consumer relationship.
And I hear you on the seismic shift, but it's also an industry that's becoming increasingly competitive. Delivery.com, Uber Eats, Grub, Fresh Direct, you name it, all of these are sort of these online delivery programs. How do you stand out?
Yeah, so we are not a consumer-facing brand. We are a software platform that restaurant brands use to build their own apps and websites. So a lot of those companies you mentioned that are consumer brands are partnering with Olo and sending orders through Olo and into the restaurants using our Rails API that enables us to syndicate the menu content out to those third-party sites and then have those orders still come through and go into the restaurant point of sale, keeping things simple at the restaurant. So we're really the partner that restaurants select as their digital ordering platform that they're building on top of, and then enabling them to keep things simple and kind of tapping into all of those other third-party sources of orders.
It's also competitive space when we look from Google's perspective. There's a lot of other mapping services, there's a lot of other search engines, there's a lot of other voice assistant programs. Why did you go with Google?
Well, there's nothing about our relationship with Google that's exclusive. This is part of our Rails platform, which is really about getting our restaurants' menus into every third-party site that they would want their menus to be listed on, where they'd want consumers to be able to find them and place orders. So we've done a similar deal with DoorDash and Postmates and Caviar and Waiter, most recently Uber Eats, and then now this announcement with Google, enabling our restaurants to really go where the consumer is and tap into that on-demand universe of customers.
Noah, you recently quoted an article talking about how this sort of keeps us within Google's framework and that it's not taking me to the restaurant site or a third-party delivery site. Why would the restaurant want that?
The restaurant really wants to reduce friction from the transaction, and sending the customer off of a search onto a third-party site, even the restaurant's own site, creates friction where a customer might have to create a new account, put in their payment details. It's great if the consumer can stay within the Google framework, have their credit card details already there as part of Google Pay, which is part of the capability of Google Food Ordering. And then the restaurant still gets to take that customer's payment on their own merchant account. They still get that customer's information so they can build a relationship with the consumer. But it's really about making sure that that consumer starts their order and converts that order within this platform.
There has been some slowing, growing criticism of Google that they are keeping all their traffic on their website and they're not letting it send it downstream to other parts of the internet. As you look generally, does that trend and that criticism concern you?
Well, it doesn't stand up in this case. I mean, in this case, Google is uniquely sharing data with the restaurant, processing the transaction on their merchant account, as I mentioned. And that's instead of the order coming through a third-party marketplace where the transaction is processed not on the restaurant's merchant account, and they don't get that same data. So I think when restaurants look at what Google is offering and the Google and Olo partnership is bringing to life, they're really happy about this as an opportunity. And since we've announced this news, we've had all of our restaurant customers contacting us and saying, we're really excited about this and we want to get on to the Google platform.
Okay, so when was the last time you used it and where'd you order?
So one great place to use Google Food Ordering is at Portillo's Hot Dogs out of Chicago, a legendary Chicago brand. And you can also use it at Checkers and Rally's, which is all around the country. Two great brands that were the first to jump on board and say, we really want to get our menu in front of consumers, and a great place to do that is on the Google platform.
Well, Noah, I'll be in Chicago this weekend. Perhaps I will check it out. That was Olo CEO Noah Glass. Thanks for joining me. Now, the Supreme Court has turned away an appeal by Amazon that will allow hourly workers at its Nevada warehouses to continue with claims for compensation. The workers say they are owed money for time they spend in required security searches after their shifts. And coming up, Facebook's Libra continues to face hurdles over regulation, and now it's finding itself in a tough position with partnerships. We discuss why next. This is Bloomberg. Facebook skeptics now have derivatives to bet on whether Libra will meet its target launch date. CoinFlex, it's a crypto futures exchange, is offering derivatives that pay out based on the likelihood Libra will be operational by the end of 2020. The initial price equates to a 30% chance of the cryptocurrency meeting that timeline. CoinFlex CEO Mark Lamb spoke to Bloomberg earlier. Take a listen.
We're really excited about this futures contract because it kind of gives the market a way to really price the odds of this event occurring. So it's obviously a physically delivered Libra, and in the case of non-delivery by Facebook, it settles at 0, and so it kind of gives the market a way to say, well, this is pretty likely, this is unlikely, respond to news events, and also give some clarity to Facebook's and Libra's partners in this whole project.
Good morning to you, Mark. Why so bearish, though? Why so pessimistic? Why only a 30% chance of hitting the December 2020 date, which is already later than Libra had planned?
Well, ultimately, we're going to let the market decide on this one. So it's not that's the opening price, but from there on after, it's just determined by anyone who wants to make a market.
Is this garnering a lot of attention for you? I mean, are you going to get high volume when these contracts open?
No, we don't actually expect very high volumes from these contracts. We do, however, expect them to be something that people are fascinated by trading, something that ends up trading a lot in terms of number of users, and ultimately, it brings interest in the exchange, and it provides a signal to the market of where Libra actually will end up being.
We have a pretty active betting market in this country, Mark. Why is it better to use your product than to just walk into a betting office and say, I'd like to put a bet on this particular outcome for this Libra product out of Facebook? I mean, they specialize in making markets in all kinds of seemingly off-the-wall stuff. So why would you not just do that? Why do you need to come out with this product at this point?
Sure. So CoinFlex is a physically delivered futures exchange. Our main products are futures on Bitcoin that are physically delivered. And if you want a physically delivered Libra at the time of expiry, that this is the place for you. If you want to make a sports bet or something like that, and if Libra gets traded on those platforms, then that's a great place to do that. But we're trying to offer futures on Libra, and that's basically what people come to us for.
Right, it's unlikely that William Hill is going to pay out in Libra if it actually happens. Mark, let me ask you the question of the day that we're asking everybody here on Bloomberg, which is, what will it take for Bitcoin to become digital gold? Now, I know Maddie Greenspan points out on Twitter that a lot of people think it already is digital gold. But what do you think it's going to take before Bitcoin throws off the shackles of this incredible volatility and becomes something that's more investable?
So I think it's ultimately usage. A lot of people say institutional adoption is where this thing needs to go, but institutions don't just buy something because it exists. They buy something because it's valuable and there's fundamentals involved. So I think Bitcoin and all cryptocurrencies need to be pushing for more adoption, more usage, day-to-day in transactions or in settlements or in any type of transactional capacity. If it's supposed to be digital gold, then it needs to be digital, and that's a big part of a lot of the things that people are working on when it comes to crypto. We're a futures exchange because we want people to be able to use crypto without the volatility.
What is the link between, so you're offering this new product around Libra. Clearly you do a lot of business in Bitcoin though. What is the link between the two? What do you expect the link between the two to be?
So, 99% of our volume is in BTC. So we do $500 million a day of Bitcoin futures. And Libra is going to be, we expect, a lot more volatile. This is a less liquid, much more volatile asset. Sometimes people want to trade highly liquid, lower volatility assets like Bitcoin, but some users want the thrill of something that's going to move around a lot more.
Bitcoin looks pretty volatile in itself.
Well, from a traditional market standpoint, you're absolutely correct, but in crypto, Bitcoin's the big daddy and the least volatile of them all.
That was Mark Lamb, the CEO of CoinFlex. Now I want to bring in Bloomberg Technology's Kurt Wagner to discuss more on Facebook's Libra. Kurt, first give me your big takeaway from that interview.
More volatile than Bitcoin is the exact opposite of what Facebook has been pitching and preaching, which is that Libra is going to be very steady. It's going to be backed by the dollar and this other basket of currencies, and it's not going to be, you're not betting on Libra. It's supposed to be something that you can rely on, that you can spend much like you would a dollar. So the fact that he thinks that it's going to be very volatile is definitely counter to what we're hearing from Facebook.
And any reaction from the market or Facebook on this new derivative product where you could basically, it's like a CDO, right? You could bet against or make a market bet on the timing of when Libra would be launched.
Yeah, it's not great optics, right? I mean, if you're Facebook or any of these partners in the Libra Association, here you are working to get something to market, and meanwhile you have this storyline and this company that's actually taking bets that you're going to fail, essentially, and not hold up your end of the bargain, your promise that it'll come in 2020. That's got to feel frustrating. And I think there's a realistic chance that Libra does not come in 2020. I mean, we've seen so many regulatory obstacles show up that I don't think anyone necessarily anticipated 6 months ago. But again, just the idea that people are now potentially making money on the fact that you are struggling, it doesn't look great.
Well, speaking of partners, PayPal has confirmed that it is pulling out. What's your take from that?
Also not good. I mean, it is one partner of many, so I will say that as far as we know, PayPal is the only one of the original 28 Libra Association members that's leaving. At the same time, PayPal was one of the most well-known of that group, and they are a payments company, and so they understand a little bit about what Facebook and the rest of the crew there were getting into, right? They understand the regulatory environment, they understand how products like this exist and work cross-border, and so for someone like that to say, hey, we see too many regulatory hurdles here, this isn't where we want to spend our time and energy, that's not a great sign for the group moving forward.
Analysts who cover PayPal say that, quote, ditching Libra makes sense. The risks were swelling. The political attention had really hurt the opportunity. That was according to Morgan Stanley. I mean, the list goes on. Anytime an analyst or group of them come out and say, good that you didn't make that move, what pressure does that put on Visa, MasterCard, all of the other 28 members who are also debating whether to go in or out?
I think it puts way more pressure on them than it does on Facebook. I mean, Facebook is one of those companies like an Alphabet or an Apple that is so big that it can withstand a lot of regulatory pressures and obstacles that other companies can't, right? I mean, Facebook prints money from its advertising business. It does not need Libra. Libra is a side project. And so for Facebook, this is a worthy, necessary cause. For a lot of these other partners that maybe don't have the stability that Facebook does from a business standpoint, and they're not necessarily being drugged through the mud every day like Facebook is, this is probably shocking to them to have to deal with all of this pushback. So Facebook is just so unique. I think where they say, hey, let's just push forward, not everyone can necessarily go in that same direction as them.
So what next?
Well, next is the charter. So they've said we need to sign this charter and get, originally this 28, now it looks like it'll be 27 members to sign. I believe that's supposed to happen next week. And so once that happens, then there's an actual, document, a more legitimate commitment from all of these members that they want to see this through. And Facebook has said, or the Libra Association has said, there's a lot of other partners that want to sign up for this. So, you get those 27 on board, you start adding more people to the mix, and you kind of look up maybe in a month or two and say, okay, who's in, who's out, and how can we actually move forward?
How do we move forward? Bloomberg Technology's Kurt Wagner, thank you for joining me. And it's still ahead. The e-scooter market drives ahead. Our conversation with the CEO of Tier Mobility. It's a European scooter startup that's challenging the U.S. unicorns. This is Bloomberg. E-scooters are a focus of a major worldwide investment, with the biggest U.S. players, Bird and Lime, valued at around $2 billion each. Berlin-based Tier Mobility is one of Europe's biggest e-scooter sharing companies and a primary competitors to those U.S. unicorns. Tier says it has raised $60 million in new financing in a round led partly by one of the sovereign wealth vehicles behind Softbank's Vision Fund. Tier's CEO spoke to Bloomberg on Monday.
We are super happy that we have Mubarala and also Goodwater now on our side, and I think we have a big mission here. And we want to change mobility for good, and that means we need to get strong investors with strong conviction, and that's what they have.
So e-scooters in Germany have only been legal since June of this year, or at least the summer of this year.
Exactly.
How has that changed the market?
I mean, Germany turned out to be the most exciting market in times of utilization, in times of acceptance just by the customers, and we are partnering very closely with the cities. So in every city where we are, we have a connection to the public transport, and as Germany, as the biggest market for transportation, this is a key market, this is our home market, and therefore it's the most important market actually in the world.
Lorenzo, what's your biggest concern? So is it, finding a solution with, with some of the cities on where you leave the scooters? Is it actually making the scooters? Is it making sure they're safe?
My biggest concern is actually our current traffic situation. I mean, if you're in London, if you're in Mumbai, if you're in New York or in Berlin, it's a mess, right? And we have to change something. And I think now it's the right time in history to really tackle the current status and give customers a better access to mobility, and that's what we're standing for. And I think if you ask about my personal concerns, I think we are going into a situation where we have to rethink cities. The cities are not made for cars, and therefore we have to find a way with the regulatories that we're going to have scooters and also alternative vehicles right in the city for the perfect safety situation.
What does it mean for regulators? How are they adapting to a huge number of e-scooters around? I mean, here in the UK, you can't, for example, ride on the pavement, but then it could be dangerous riding with the cars.
So currently the city is designed for cars. And as cars are not the right vehicle anymore, we have to rethink how we're going to transport ourselves in the cities. So we need we need more biking lanes, wider biking lanes. And this gives also the users for scooters a better chance and actually a better structure to go through the cities. So we actually have to partner with the cities to make sure that we have enough space for those vehicles, and then it's also, I mean, a lot safer than before.
Yeah, I mean, people worry that the buses can't get through because there's too much traffic, but if you look at your competitors in the US that are so much bigger and that are actually expanding in Europe, do you have any intention to expand in North America?
Well, I think as I said, Germany is the biggest market for transportation in Europe. Europe has turned out to be the most attractive market. So we believe completely in Europe. This is our complete focus now. We're going to win Germany, we're going to win Europe, and then we can see. But I think for us it's very important to be laser focused, and that's Europe.
Do you think the industry will have to consolidate because there are so many active e-scooter companies?
Sure. I mean, there's always a question about making the cost structure more efficient and try to consolidate. But I think we are in a very early point of time. I mean, our company is around 12 months old now. So we're just at the beginning of this disruption. And therefore, I think there will be a point of time where it would make sense. And let's see.
What comes after e-scooters? I don't know if it's a small electric vehicle, personalized electric vehicle, or something else. Is there something that you think has been untapped in this space?
We have a clear path to create a new vehicle, and I think we are not far away from that. And it will be a vehicle that's suited for the cities, that you can drive easily also in the rain for the winter season, which is very important. And this is something where we're currently working on. So we will increase our fleet of new vehicles, and this is part of our company. We're not an e-scooter company. We are a micro-mobility service provider, and we want to give you as a customer different vehicles that you can transport yourself through the city.
How important is it to be big as soon as possible to get market share, or otherwise the US will eat your lunch?
Well, I mean, size really matters here in the sense of that you need enough access to capital. But if you compare us to the American players, we raised around 30 million in our first round, and we reached 10 million rides faster than anyone else in the world. So it's not about just collecting money. It's very much about how you invest your capital and how efficient you are. And I think this is something where also Mubadala and Goodwater really sees us as the most capital efficient company, besides being the fastest in the industry.
That was the co-founder and CEO of Tier Mobility. And that does it for this edition of Bloomberg Technology. Bloomberg Technology is live streaming on Twitter. Check us out at Technology, and be sure to follow our global breaking news network at TikTok on Twitter. This is Bloomberg.